Welcome everyone to Leaders in Business and Investing. Today we have a very special guest with us, Mr. Whitney Tilson. Mr. Tilson is the proud founder and CEO of Empire Financial Research, which aims to provide advice, commentary, and in-depth research and analysis to help people around the globe become better investors. His first newsletter, the Empire Financial Report, was launched in April 2019. Mr. Tilson also founded and for nearly 2 decades ran Case Capital Management, which managed 3 value-oriented hedge funds, 2 mutual funds. Mr. Tilson has co-authored 2 books, The Art of Value Investing and More Mortgage Meltdown. He was also one of the authors of Poor Charlie's Almanac, The Wit and Wisdom of Charles T. Munger, the definitive book on Berkshire Hathaway Vice Chairman, Mr. Charlie Munger. Mr. Tilson is set to release his latest book, The Art of Playing Defense. We were lucky enough to receive an early copy. I highly suggest everybody check it out. Mr. Tilson, thank you for joining us. It's a pleasure to have you here, sir.
My pleasure. Thanks for having me.
And so we see the elections are almost around the corner. And I think by the time this video will be released, we'll have a winner, hopefully. Just to begin with that, what do you think the long-term effects, especially in terms of policies, economic policies mainly, would be depending on which candidate wins, which party is the majority?
Right. Well, I don't think there's a lot of mystery if Trump wins re-election. I suppose he could win re-election and Democrats could win the Senate, though that would be surprising. I think things will correlate there. As for Biden, I do think there's some uncertainty in that, you know, his 50-year political career, he's actually been fairly on the moderate side of the Democratic Party. There's a lot of concern out there among Republicans and people who oppose Biden saying, well, maybe he's not so bad. But one, he's old. He would be the oldest person ever elected. And that he could be replaced by Kamala Harris if, heaven forbid, something happens to him, and or he will let the left wing of the party, you know, Elizabeth Warren and Bernie Sanders and AOC run roughshod over him. So that's what we can expect, and they predict that we're going the way of Venezuela if there's a clean sweep for Democrats, which is, by the way, what the polls right now show is likely. That is my working model, not based on a political belief, but based on, for many elections now, I carefully follow the polls, lots of different websites which have different models. The one that I have found to be the best, in my opinion, is 538.com. They currently give Biden an 89% chance of winning, Democrats a 77% chance of taking the Senate, and a 98% chance of holding their majority in the House. Again, maybe I'll have egg on my face by the time someone's watching this video, but my guess is and again, this is not, I'm not making a political statement. As an investor, as an analyst, as a business person, it's critical to put aside your political leanings and your emotions around that and focus on the best assessment of odds and numbers. And that's what investing is all about. It's making high probability bets. So my best guess is, and I did meet Biden years ago, and I've studied him fairly closely, and he won the primaries. He will be the elected president. So I somewhat dismiss the concerns that, you know, it's going to be a Bernie Sanders style agenda. It will certainly be a progressive agenda. I do think that means corporate tax rates are likely to go up somewhat. Taxes on the wealthiest folks are likely to go up somewhat. There will be greater enforcement of environmental regulations, worker protections. The government will tend to be friendlier toward unionization. Many business people view that as a very hostile agenda. I think it'll probably be more of a recalibration to the way things were before Trump came in. And the economy, keep in mind, was rebounding for about 8 years under Obama by various metrics at a fairly healthy rate. By some metrics, it grew faster. The stock market certainly did well under Trump. But historically, what's interesting is if you go back and look at the last 100 years, the stock market has tended to be roughly the same within margin of error, regardless of who is in power, and even if one party or the other had full control of the government. So my main message to people who are freaking out about the election, and by the time people are watching this, the aftermath of the election, is, this election is an important one, and the outcome will have long-term consequences for this country, but I'm actually fairly sanguine about the stock market. I think there will be substantial ongoing monetary and fiscal stimulus, and we will see a recovery from the economic impact of this pandemic, irrespective of what the outcome of the election is. So I'll just conclude this sort of long rambling thought with a point that one of them, I study and teach behavioral finance, which is the study of how investors are irrational when it comes, how human beings are irrational when it comes to money and financial decisions and investing decisions. And one of the big behavioral finance traps that people fall into is they overweight vivid recent evidence. So as a simple example, a great company has a little bit of a bad quarter and the stock sells off by 25%. That's the kind of opportunity I look for as an investor, where investors are, I think, overreacting to vivid recent evidence. Don't fall into that trap when it comes to the results of this election.
Mm-hmm. Wonderful. I think the biggest concern that at least people in finance have is, if we see a more aggressive tax policy, how will that affect the long-term valuation of mainly common stocks? And do you think we should expect something in the high 60s to 70s as far as marginal tax rate is concerned? Or
yeah, mathematically, obviously, for taxable investors, the higher the tax rate is on your gains, the lower price that you should be willing to pay for an earnings stream, right? There's some things to keep in mind. I don't think Biden is going to go crazy and jack taxes truly through the roof, number one. Number two is keep in mind that about 2/3 of stocks are owned by people that do not pay taxes. That would be foreign investors, endowments, and people owning stocks in their IRAs and mutual funds in their IRAs. So it's only 1/3 of investors who even have to think about taxes. And thirdly, actually, if you look back to the 1950s, a time when of great middle-class prosperity and a strong U.S. economy and very strong stock returns, the marginal tax rate for the highest earners was 90%, and nobody's talking about going back there. So for a variety of reasons, I guess that's why I'd say, again, even if Democrats win a clean sweep, I think there will also be some offsetting factors. I think we're more likely to get a stimulus bill passed fairly quickly after the election in that scenario. And Biden has called for a lot of spending on infrastructure, on clean energy. So in other words, yes, taxes may go up somewhat, but those tax revenues are going to be reinvested back into the economy, and that's good for businesses, that's good for stocks. So, I'm not saying I think stocks are going to do better if Biden wins versus Trump wins, if Democrats do or don't win the Senate. I'm saying mostly it's sort of too hard to know, but irrespective of if you're at one extreme or the other, you're probably wrong. Stocks, I think, are going to do reasonably well under any reasonable scenario. Now, the unreasonable scenario, I should caution, is if it becomes a contested election, if it's close, if Trump refuses to accept defeat, if it goes to the Supreme Court, if there are Trump supporters and militias out there with weapons in the streets, if heaven forbid violence emerges, that kind of thing, that's clearly bad for stocks. But I don't think that's likely.
Mm-hmm. Wonderful. So you do talk about the market being, in the long run, it shouldn't be affected that much by what these events are, right? Which brings us to your investment strategy. Could you speak a little bit more about that and how it has evolved over time?
Sure. Well, look, there's my personal investment strategy, and I write or co-author 2 of the 5 publications we have, but my colleague Enrique Abeda writes the other three. And then my other colleague, Berna Barche, we're going to launch another product under her umbrella. She's currently just writing a free daily. I have been, it's sort of funny. So under the Empire Financial Research umbrella, we have a real diversity of opinions and investing approaches among the three of us, Enrique, Berna, and I, who give the stock recommendations and write our publications. I have been, and Berna really have both been classic value investors. We pray in the church of Graham, Dodd, Buffett, and Munger. We've been long short investors, focused on fundamentals. And frankly, that's been a tough road the last 10 years or so. Value investing has substantially underperformed growth investing. I'm delighted that more of a growth investor like Enrique, who even publishes a weekly trading newsletter for us, a SPAC newsletter, and then a long-term growth where he's looking for 5 to 10 baggers, Empire Elite Growth. It's been very healthy having him under our umbrella because I've learned a lot from him. Because I will say, we value investors tend to be too focused on near-term valuation, whereas growth investors look 5 years out and dream about where a company might be. And, classic value investors say, yeah, but you can't predict 1 quarter out, much less 5 years out. So shame on me. I used to own Amazon a long time ago. I owned Apple a long time ago, and they went up a little bit, and then I sold them. And I should have obviously just hung on, and I'd be worth hundreds of millions of dollars right now if I had simply held on. I should also mention Netflix. I owned it literally the day it bottomed 8 years ago, about a 60 bagger ago. So that's a particularly painful one as well. So, as an investor, I think I've evolved in a couple ways. One, I'm more willing to invest in technology. I'm more willing to pay a higher near-term multiple for truly great companies where I am willing to look out 3 to 5 years. And very importantly, I think it's critical to let your winners ride. And again, if you're just focused on near-term valuation, I found, Netflix went up. At the bottom, I went on national television. I published a slide deck. I gave a speech at a conference, basically showing that Netflix, on a per subscriber basis, was being valued at 1/10 that of Hulu, a far inferior business. So in other words, I had correctly identified a 10-cent dollar that we now know was a 10-cent dollar. So why, when it doubled and it became a 20-cent dollar, did I sell it? Not all of it, but I sold about half my position. And then it doubled again, and I sold half my position. But it was still crazy cheap. Even having quadrupled, it was still a 50 or 60-cent dollar, right? And maybe more because the company was growing over this couple-year period. So, when I look at the most successful investors of all times, it's been the ones who've had the smarts to correctly identify 1 or 2 or 3 insanely great businesses that compounded a high rate for a long period of time. But they not only did that, it was equally important that they had the wisdom and the humility and the patience to just let that compounding work for them over 10, 20, 30 years. And so I can tell you about friends of mine. Chris Stavru bought Berkshire Hathaway at a few $100s a share, and he still owns those shares today at $300,000 a share, 30, 40 years later. Mm-hmm. Tom Russo bought Brown-Forman, maker of Jim Beam whiskey, for example. He's never sold a share in 40 years. He's owned Berkshire Hathaway for 30, 40 years, right? So look at Warren Buffett and the compounding he's had by owning private businesses like See's Candy, but also public stocks like Washington Post and Coca-Cola, and so forth. So that's the hard part. We investors and human beings in general tend to be impatient. We want to get rich quick. So if we find a stock and it does really well and it doubles, we figure, well, let's sell it and find the next stock to double, right? But it turns out if you find a great stock like a Netflix or an Amazon or an Apple, the most important thing to do is just let your winners run.
Mm-hmm. Wonderful. And it's always a problem when you have thousands of stocks out there. And how do you really filter out maybe or screen out investment ideas, and maybe how that has changed over time?
Yeah. It's hard, and it helps to have sort of good filters and good, Malcolm Gladwell's book, Blink, where it's about the concept of people developing expertise where they can then make very rapid, correct judgments. So for example, someone who's in the art world can instantly look at a painting and tell whether it's a fake or not, just based on like gut instinct. So, developing a lot of experience and doing a lot of reading and studying of investing in general, developing good screens and good blink reactions is really important. I'm looking at dozens of stocks every day, but only maybe once a week do I find anything interesting enough that I'll toss it over to my analyst to take a quick initial look at it, right? So that comes from experience, but developing expertise in at least a couple different industries helps. My colleague Berna, for example, has been in the retail and consumer space for most of her career, and she knows I've never been able to stump her in that space. I'll mention any public company, any private company even, and she instantly can, rattle back everything about that company, right? So developing, it's good to be able to fish in a lot of ponds, to have a broad circle of competence, but it's also very important to develop real depth and to specialize somewhat. And that could be by industry sector, but it could also be a particular country. I talk to a lot of young people who either they or their parents are from India or China, two areas of tremendous growth. And I urge them, don't come over here to the United States and try and outwit me on Berkshire Hathaway, a stock I've been studying for 25 years. Take advantage of the fact that you have local relationships, the local governmental systems and stock markets, and you speak the language. And so I've given this advice to young investors from Israel, for example, from Italy. Develop an expertise in a smaller market, a smaller country where you have an edge over everybody else. It's all about developing an edge. And there are a lot of different ways to develop an edge. It can be your base of capital. It can be your internal temperament and just having better patience. It can be just being smarter than everybody else, but you're likely to be smarter in an area where you have an edge, of course. So that's the main message.
Mm-hmm. Wonderful. And you mentioned understanding some industries, going deep on maybe 2 or 3 that you should know really, really well. Do you see any industries that you have found attractive? I know you mentioned electric cars as one of those upcoming industries that you find promising. Do you find any others, or could you speak more about that?
Yeah. Well, look, it helps. I'd say very importantly, look at industries that you're personally interested in. Because if you're not getting up in the morning psyched about what you're doing, what Buffett calls tap dancing to work, you're unlikely to develop the long-term commitment to something to really learn about it. A second area I would point to is an industry with attractive economic characteristics. Like, hey, it's great if you're really excited about cars, but what a miserable industry, right? Or maybe you wrote for the school paper and you sort of like to write in journalism and all, and you love reading the newspaper. Well, gee, that's an industry that's dying. That's just a melting ice cube, right? So to some extent, look for industries, software as a service, or in some people, if they have a medical background and all, figure out biotech, and there's lots of opportunity there, lots of inefficiencies there, right? Mm-hmm. So look for industries that have good economic characteristics where maybe there are inefficiencies. I actually have picked up a little bit of expertise in things like retail and restaurants, and which are not necessarily bad businesses. Restaurants in particular, the franchising business is an incredible business. McDonald's was one of my biggest winners of all time, and I should have just held it. I held it for about 6 years, and I should have held it for 16 years, the last 10 years as well. Look at Chipotle, which was a spin-off out of McDonald's. Shame on me for missing that one. Look at Starbucks, right? Yep. The nice thing about retail and restaurant businesses is they report monthly comps, and that tends to make investors think very short term, and they overreact to short term same store sales numbers. And so, that can create, if other investors in this sector are very irrational and emotional, that's something I actually look for. Other people, they like, most investors, they like stability and, big giant, I don't know, consumer products companies, or, how many investors thought they were being concerned buying oil companies, paying nice, healthy dividends, and they've just gotten absolutely destroyed.
Absolutely. And we've also seen over the past decade or so, pretty much all hedge funds have had a tough time over the last decade, but value in particular, long short especially, has struggled quite a bit. What do you see happening to that particular strategy, maybe value investing, or even hedge funds in general, over the next decade? Where do you see?
Well, interestingly, I mean, hedge funds have been sort of bleeding assets. They've terribly underperformed the market ever since the global financial crisis that they weathered fairly well. Not surprisingly, I suppose, hedge funds tend to hold cash. They tend to have a short book. That helps them outperform during downturns. But, we've had, other than the big drawdown earlier this year, we had pretty much prior to that the longest bull market in history. So it's been a tough time. Shorting is really ultimately what cost me my hedge fund business and why I decided to close it. In part, I was too narrow-minded about my and about this long bull market, and sort of at every point I thought it was ahead of itself. So I was playing defense at a time when anything you did to play defense just cost you performance and led you to underperform. And so, I was making my investors a little bit of money, but not nearly as much if they just owned an index fund. It was very frustrating for me, but particularly my short book was crushing me. So, my main advice to 90 plus or maybe 99% of people out there is just don't short. It's a terribly difficult business, and it's gotten even more difficult with a lot of technical factors. It costs a lot the borrow costs a lot. You've got a flood of liquidity working against you. The fiscal and monetary stimulus since the pandemic hit is absolutely unprecedented. So you're running the risk of being short into a stock market melt up, which my colleague Enrique thinks is likely, that I certainly think is possible. So shorting's a terrible business, and those that are doing it, I think, are likely to continue to underperform. I think my friend Bill Ackman of Pershing Square, after he engaged in a very long and brain-damaging campaign against MBIA that had a big payoff at the end, but then did the same with Herbalife and ended up losing his shirt. He abandoned all short selling. He abandoned turnaround situations like JCPenney and Borders Group, both of which where he lost his shirt. And instead, he went back to buying just insanely great companies, holding them for the long term. And that's really, I mean, he's really come back in a big way. So I really have a lot of respect for someone like that, who, went through a very difficult period, lost a lot of assets, was being pilloried in the media, and pivoted, refocused, and so, I think that's my general recommendation to individual investors as well. Own 10 or fewer stocks, ones that you've gotten to know very well, that you think where you're looking out 3 to 5 to 10 or more years, that you think have big moats around them, and so that they're just going to continue to compound. And, at most, maybe trade out one stock a year. Otherwise, just stick with some insanely great companies and let compounding work for you. And by the way, if you're running taxable money, that's, the after-tax returns from that strategy are going to be massively higher as well, because you're deferring paying the taxes. You're not realizing your gains.
Wonderful. And of course, to what extent do you think the industry is fundamentally changed? We have almost over 10,000 hedge and mutual funds in the US. Looking at 3,700 securities or so.
It's gotten crowded, and I think my colleague Enrique has an interesting philosophy that I think is actually correct the more I think about it, which is you should either trade a lot or not at all. your turnover should either be sort of weekly. You're in there just looking for singles and quick pops. And he actually has a newsletter called Empire Elite Trader that's every week. He pitches an idea, and usually every week he's covering an idea. So maybe he has, I don't know, 12 stocks or 15 stocks in his portfolio, but he's just looking to hit singles and doubles over and over again. And he's got something like an 80% hit rate, right? But then he also, and this is more what I do as well with my newsletters, he has Empire Elite Growth, which is looking to hold for 5 years, looking for 10 baggers. And that's what I do as well. And so I think both of those approaches work. I think a lot of hedge funds, like I did, got caught sort of in the middle, right? You either need to be a trader and be a good trader, or you need to be a very long-term oriented investor and just ignore the short-term noise. And by the way, I highly recommend the latter for the vast majority of people. Most people just aren't good traders. Now, if you subscribe to Enrique's newsletter and you follow it, well, you can piggyback on someone who I think is a brilliant trader, but it also just sort of sucks up a lot of time and so forth. It's so much better to just own some high quality companies and tuck them away and maybe think about them once a quarter when they report earnings, or maybe just take a look once a year. It's very frustrating and irritating to me that the little side account that, I ran for my parents in their retirement fund that just sort of owned, Berkshire Hathaway and Apple and just a few stocks that were just sort of obviously great, vastly outperformed my hedge fund, which is where I spent all of my time and energy. Well, it turns out that most of that time and energy was did not only not add value, it subtracted value. That's what I talk about in a book called The Rise and Fall of Case Capital that I'm just finishing, that will be out either this fall or next year sometime. Sharing the story of my rise, where I took $1 million fund operating out of my bedroom with not a day of experience in the industry. And for 12 years, I crushed the market. I tripled, my fund tripled in value. It grew from 1 million to 200 million, but my investors earned a 200% return, a triple in a flat market. And then many mistakes I made to then underperform the market and ultimately close the fund in frustration. So hence The Rise and Fall of Case Capital, the title of the book. But I share a lot of investing lessons in there, some of which I'm sharing right here with you.
Mm-hmm. Wonderful. And moving on to your second book, The Art of Playing Defense.
Right.
You talk about how individuals can get ahead by avoiding big pitfalls in life. What was your inspiration to take on such an approach to this work?
Right. Well, it was Charlie Munger. Other than my parents, Warren Buffett and Charlie Munger have been the two biggest mentors to me and influences in my life. And it's a philosophy of avoiding calamities that they both talk about, but particularly Munger talks about it. And I remember it was probably 20 years ago at the Wesco annual meeting, it was sort of a follow-up smaller meeting after the Berkshire meeting every year, that Charlie Munger was the chairman there. And, maybe only a few hundred people would come to that meeting. So you could really ask your questions and so forth. And I remember in responding to some question, he said, all I want to know is where I'm going to die, so I never go there. And I laughed and everyone laughed. And he said, no, I'm serious. Once you reach a certain point in life, your main goal should be not to lose what you've got. So imagine a lot of people, I'm sure, watching this video have had the benefit of a good upbringing, a good education, they have a good job. Hopefully, if they're married, they're happily married. They have good relationships with their children, with their siblings, with their parents. Hopefully, I hope a lot of people watching this can say that, and I can say that about myself. Once you've gotten to that point, if you're lucky enough to have gotten to that point in life, your main goal should be thinking about what are the things that could cause me to lose these good things I have in my life, to lose my happiness, my health, my relationships, my reputation, my wealth. Most people, though, don't think that way. It seems just like such a negative way to think about the world, about what could go wrong. But in fact, the best way to achieve long-term success isn't just, reaching for that brass ring and taking that huge leap forward. it's doing all the right things to steadily make progress, yes, but equally importantly is not having those big setbacks that can send you back to go. And so, you know, Munger, that when I heard Munger talk about that philosophy, and he gave examples, and he said, just open the newspaper every day and you can see people who have been enormously successful, and then they ruined it by, you know, reckless decisions, and, you know, cheating on their spouse wrecks their marriage, or doing insider trading just once causes them to lose their business, lose their fortune, and maybe even end up in jail. Or to decide that, you know, riding a motorcycle at high speed without a helmet is a good idea, right? So I've got a book that, my book, The Art of Playing Defense, is about it's the sort of the subtitle. It's not the official subtitle, but the theme of the book is I've identified 5 calamities that can destroy your life. And then I've got some ideas on how to avoid them. And these are, you know, calamities like having your marriage fall apart, marrying the wrong person, and or having your marriage fall apart is one of them. Having an illness or an accident that of you or a loved one that gets you killed or suffering permanent disability is certainly another calamity. Loss of wealth or reputation, addiction or abuse, and loneliness and ruptured relationships. Those are the 5 main calamities. And it's a book from my heart that I've written for my 3 daughters primarily, who are just entering adulthood. Their ages 24, 21, and 18. And I'm really writing it for an audience of 3. But I decided, you know what, you know, why don't I write down my thoughts? Because I'm not very good. I'm not as good at talking to them as I am at writing a book, right? So I'm writing this book, and I'm hoping it might benefit some other people as well.
Mm-hmm. Absolutely. I mean, I read the whole thing. It's pretty unique in the sense that it's all about what you shouldn't do. Typical. It's not the typical self-help book in the sense that this is what you should do. It's
right.
the opposite approach.
Right. Well, when I started to write the book, I was writing it. The first 2/3 of the book were going to be on here are the things you should do, and then the last third was going to be here are the calamities to avoid. And then I got about 4 chapters in, you know, a chapter on working hard and having high integrity and being nice to people and becoming a learning machine. And then I just lost momentum. And for, I don't know, 6 months or a year, I just put the book aside, and I couldn't figure out why I had lost momentum, but just I'd lost my mojo on the book. And then I realized it was because I was writing a book that's been written 500 times before, right? I mean, there are millions of books out there, you know, on work hard, be nice, you know, develop your brain and become a learning machine, etc. That's boring. It's uninteresting. It's been written 100 times before. It was the last third of the book that I was really excited to write. So I just decided to make that the entire book.
Absolutely. It's a wonderful book. I'll highly suggest everybody check it out. And you also talk about being a giving machine or becoming a giving machine.
Right.
And you've been involved in philanthropy all your life, basically. How would you approach that topic? What should be the mentality? Maybe how should people, because they do find themselves being extremely busy sometimes with their life.
Right.
How can they contribute? Maybe, I mean, how would you go about it?
Right. Well, let me, I want to broaden it beyond just philanthropy and, you know, writing a check, donating money, volunteering at a homeless shelter, a soup kitchen, or a charter school, or something like that, which is important. But more broadly, there's a terrible myth out there that I hope young people don't pick up. You know, the idea that nice guys finish last, that to get ahead in your career and in your life, you sort of have to step on other people. That's a zero-sum game. You know, sadly, I'm not going to get too political, but, you know, sadly, I think one of the messages that our current president sends in virtually every action that he takes is that mythology, right? My experience is exactly the opposite. I know multiple billionaires. I've met so many CEOs and so forth. And nice guys finish first. You know, people who work collaboratively, who have empathy, and who can sense how other people are feeling and are sensitive to that. And people who sort of go out of their way to do favors, do nice things for other people. It's a great way to live your life in general. It will result in much stronger and deeper relationships in general, which is the single most important part of leading a happy life, is having very strong relationships, not just within your family, but a very strong network of friends and so forth. So behaving that way is the single best thing you can do to have those strong relationships. And this is something I talk a lot about in my book. You know, which is the opposite, of course, of avoiding the calamity of ruptured relationships and being lonely. There's an epidemic of loneliness, not just in the United States, but around the world today, right? Mm-hmm. So being a giving person and looking for nice things you can do for other people, and all. But I'll tell you, it's also the way to get ahead in life. I mean, even if you're not a giving person, even if all you want to do is just get ahead and make as much money as possible and get ahead in your career, then I would still urge you to pretend and behave like you're a giving person, because it's the best way to get ahead, because people can tell if you're a selfish jerk. And yes, you know, you can look at a handful of people who tend to get a lot of press, of course, and think, oh, wow, that selfish jerk made a lot of money as CEO of the company or something. But the reality is the vast majority of successful business people, and just in whatever career or profession you're in, tend to be nice people who other people want to see succeed and who will help you succeed, because they know that in your heart you'll do good things for them, you'll reciprocate and so forth. So a part of this, by the way, is giving back to the world and trying to leave the world a better place than the way you found it. So I'd strongly encourage everyone to find a charity that they're interested in and passionate about, whether it's education or the arts or you know, helping the indigent in some way, whatever, right? I happen to be very involved in a couple different areas. My parents and my sister live in Kenya. I spent 3 years of my childhood in Tanzania. So I've gotten involved in a number of charities in Africa. And again, you can see that sort of makes sense. Like, try and find charities that you're personally interested in and have a passion for, right? So I'm also was one of the founders of Teach for America. It was my first job out of college, was helping Wendy Kopp start Teach for America in 1989 and 1990. So I've been deeply involved in education reform and charter schools. And then I've more recently, maybe in the past 5 years, gotten involved in criminal justice reform efforts here, and I co-chair Central Synagogue's criminal justice reform initiative here in New York City and New York State. So those are the areas, and it's a big area. You know, I've now reached a position in my life where I can write checks, but also have experience and relationships that I can really make an impact philanthropically. And so it's very rewarding for me. For younger people, look, most importantly, you need to invest in yourself, you need to invest in your career, and get to the point in your life where you can start allocating more of your time to philanthropy. But no matter what, find one or two charities to at least volunteer with and maybe get on the board of, because it's the right thing to do. But it's also, again, it's in your self-interest to do it. Being known as a philanthropic person has helped me in my career. And I've made great relationships, business relationships through my charity involvements. So again, even if you don't have a charitable bone in your body, I'd suggest getting involved with a couple different charities because it is actually in your self-interest to do so, though I hope that's a secondary reason for it.
Mm-hmm. Well, that's a wonderful thought that we would like to end on. Obviously, it was a pleasure having you on the show, sir. I would highly suggest everybody check out both his books, Art of Playing Defense and Rise and Fall of Case Capital. Should be hitting the stores soon.
Right, you can't order them yet.
Yeah.
And by the way, I do publish for those folks who are interested in investing. I publish a daily email that goes out to over 100,000 people every weekday. And you can just go to the website of my business, empirefinancialresearch.com, and just pop your email address in there and start getting my dailies.
Absolutely. Thank you for coming to the show, sir.
My pleasure. Thanks for having me.